Awesome. Howdy. How are y'all doing? Good. Much better. Welcome. Welcome to Capital Factory. Welcome to Austin Startup Week. How many of y'all, this is not your first event during Austin Startup Week? You've been to an event before. Great. Keep going to events. This is an awesome place to meet the entire ecosystem, everything going on, investors, press, startups, other service providers, everything. So my name's JD Weinstein. I work with Capital Factory. Capital Factory being the entrepreneurial center of gravity for everything entrepreneurship, I guess, in Austin, Texas, downtown Austin. So we're a number of different models. We are a co-working space. We've got an accelerator program. We have a venture fund that runs alongside that. We've got this huge event center, so we do over 60 events a month. This week we'll probably do, I think, over like 20 events a day. So it's very wild and crazy, but the goal is to get every talented entrepreneur and developer and anybody interested in the scene in the same place so that you guys can kind of have serendipity and interesting things and magic can happen from there. But this panel specifically going to be how to meet Austin investors. Can everybody hear me okay in the back over there? Cool, perfect. So I'm going to run through and give you all really the short kind of overview of how Austin came to be, where the investors are from, what kinds of investors we have here in Austin, both angels and venture capitalists, what the names are of everybody, what kinds of companies they want to invest in, and then we're going to have a panel with two of the most active early stage investors, Krishna Srinivasan, who's a general partner at Live Oak Venture Partners, and then Matt McDonald, who's a partner at Notley Ventures, a social impact venture fund here. So from that, I'll open it up to you guys. So I'll probably go on for about a half an hour, get this part out of the way, and then we'll get to the fun stuff. Sound good? Cool. Awesome. So quick thank you to our sponsor for this event, and then also for Austin Startup Week, Janik Vinacoda. So they are IP litigation firm. They do specialize in startup formation and then anything patent litigation. So if you have questions about kind of protecting yourself moving forward, whether it has to do with IP law or just how do you do it without filing for patents, these are your people. So they mentioned they're super interested in Austin startup world. You can find them afterwards.
Austin is really becoming a well-respected tech hub, and Capital Factory is at the center of that.
We came in with this idea of like we're going to start a company together because we start companies together.
There's so much going on here, and there's just the right mix of people here.
Okay, we're skipping over that part. How many of y'all just took the tour? How many of you, keep your hands up, how many of you taken a Capital Factory tour? Okay, awesome. So you all have met Liz. She's probably a lot more bubbly and exciting than I am, but I'm going to talk about interesting things here. So there are a number of things we do in Capital Factory around different info sessions having to do with the Austin startup ecosystem, with accelerators. This one's specifically geared towards how to meet investors and what types of investors those are. So recommend, if anyone's got a phone, does anyone have a smartphone? More than welcome to take that out. You can tweet at ATX Startup Scene. You can take pictures of the different slides and things that I'm going to run throughout the presentation. We'll move pretty quickly, so feel more than free. You're more than free to do that. With that, we'll kick it off. So also, if you want to find this online, I believe we'll have the most updated version. That second link right there, the SlideShare link. You'll be able to check out all these slides and then all the presentations. We do them once a month. So every Tuesday at 4:30 p.m. there's a different intro to session. How many Austinites do we have here? How many people live from Austin? Cool. How many visitors do we have? Welcome. You got? Keep your hand up if you're considering moving to Austin. You should move to Austin. Except for allergies, apologies for that, and traffic. Everything else is good. So do your homework online. So here's a couple of really, we put together kind of our top blogs and books and things that to read up on the subject of how investors like to be pitched in different ways. And these are the five that came to top of mind. Paul Graham, YC, Wealthfront is a really great clip, and then Sam Altman. So take a picture of that. And then a couple of really awesome books. Get Backed is a book, New York Times bestseller by Evan Loomis, to local Austin entrepreneurs that recently came out with this book talking about the different funding mechanisms. And then my all-time favorite book in kind of this ecosystem, this world, is Venture Deals. Brad Feld and Jason Mendelson, who are Techstars folks, wrote this book. And what it gives you is a perspective of how a lawyer looks at a company, how an entrepreneur looks at a company, and how an investor looks at a company from all different angles. So you're really able to understand where everybody's coming from. That's a strong book I'd recommend. And then Startup CEO from Matt Bloomberg, also awesome. So kind of different about fundraising in Austin. Austin, we have this blessed place, of course. Austin is ranked number one at the top of the list every single year for, fastest growing city. We were recently ranked in the Kauffman Fellows, or out of the Kauffman Foundation, as the number one startup activity city in the entire country, not specifically in venture capital, but with startup activity. I don't know how they measured that. But so Austin has different roots than both the coasts. And when we're comparing Austin, we're really comparing them both to Silicon Valley, so kind of the West Coast, and then Boston and New York, East Coast, right? So Austin is very much a what we call a bootstrap first city. Most of the companies that have made it that have launched from here have started out as bootstrap companies. It's super well respected, kind of bootstrap compared to angel investing or venture funding. This is predominantly in the tech world, but can be with any kind of startups that you are growing. Bootstraps, obviously, well, not obviously. What it is when you take all the resources that you have as an individual or the revenues coming in from your business, and you grow your business with just that, meaning that you're not taking any outside funding. So a lot of investors like to see this because it shows a lot of validation what you can do just by yourself without any of their money at risk. The reason you take funding is to scale and grow faster, right? But we're a very revenue-focused city, so a number of investors here, both angels and VCs, want to see that you're getting revenue, or we'll say traction. Different companies, there's different ways of measuring them. So I mean this, for example, if you are let's just say you're an app company and you are trying to sell people to go to the most interesting bar at any given time. Like, you better have hundreds of thousands of users and like really interesting metrics and people staying on the app for a number of time and revenue coming in from advertisers and bars, whatever. If you are, let's say, a company that has an enterprise software for hospital systems and you have pilots with some of the most major hospital systems in the country, that counts, right? Like, that checks the box of having some significant traction. So revenue focus, next one. Experienced teams. So, there's different ways to go about this, and we'll get into the panel later of kind of what typical VCs and then, accelerators and small venture funds look for. Team is almost always going to be the number one kind of term at the top of all these lists, right? Specifically, experienced teams means it could mean, hey, I've sold these 3 companies, and I'm a serial entrepreneur, and I took these 2 companies public and sold this one. It can also mean you've been in the industry for a while. It could mean that you're super passionate, you've had that pain personally. You relate it to whatever your story and your strength is, and make yourself an experienced team. Find co-founders that complement you, of course, and so forth. So with that, we'll jump into how to meet angel investors. So really quickly, kind of just a quick side note for those that are newer to the world. Obviously, we've got 2 really active sources of funding in Austin, probably 3 actually with crowdfunding, but angel investing, venture capital investing, and then crowdfunding, meaning like a Kickstarter, Indiegogo, or syndicates on AngelList, which is really just new and exciting in the last couple of years. But the difference between angel investors and VCs, angel investors, they've already made their money. This is not their full-time job. They don't need to do this. Like, they could spend $25,000 and like put it in your company, or like they could go buy another car or something, right? Like, it's, it doesn't really matter. They look at it, they want to coach you, they want to go on the journey with you. It's a really rewarding experience, why a lot of angel investors are in this. Venture investors, for venture firms, they are professional investors. This is their real job. They have a fiduciary responsibility to their limited partners, people that invested in them. And so they are usually a little bit later, and they are solely focused on the business, growing the business, looking at numbers, metrics, and so on. So those are the difference, kind of just so you understand the heads of those two groups. So with that though, meeting angel investors, getting in front of angel investors. Kind of first lesson before I run into this is, if you ask, many of you may have heard this before, but ask for money, you're going to get advice. And if you ask for really good advice, you're going to get money, right? So like as you engage in a different, there's a lot of dating analogies kind of with angel investors, but as you engage them and they fall in love with you, that's when they want to go on the journey with you. So of course, leveraging your personal network is going to be number one. Any warm introduction you can get, but hey, there's a number of you that just moved here, so hey, where do I hang out to meet some of these investors? You want to go where they are. So bars, coffee shops, events, Capital Factory is one of the major hubs. Galvanize, another great place. There's a number that we can go through at the end here, but bars, like if you're looking for angel investors, the W Bar, a Saturday night, a lot hang out there. Lola Savannah, a coffee shop in Westlake, really nice part of Austin. Pretty easy to spot where they're hanging out. Following them on Twitter, Josh Bear's got a list of all the Austin Angels that you can follow this list and see all of them. And then on Angel List, a number of them have Angel List profiles, list all the companies that they've invested in. If they're really active and want to be showing that, they'll have a profile. And then also office hours with CTAN. CTAN is a Central Texas Angel Network. We have the most active or largest amount of money invested by any other angel network in the entire country this last year, Central Texas Angel Network. They do office hours with entrepreneurs, I believe. Quarterly are their cycles, and they do them at Abel's on the Lake. Epic office hours at Capital Factory if you're just coming into the world in this ecosystem. Epic office hours is open to the public, and we put different themes on them, so we get all these interesting investors and mentors in the room around social impact, or female founders and investors, or whatever education tech companies and founders, whatever it might be. We do those monthly. Of course, our plug of joining Capital Factory's community member, and then accelerators. So accelerators and pitch events, and we'll get to accelerators soon on. But accelerators, and other incubators, there's dozens of these, just even alone in Austin. And what you really want to look for there is you want to look at the people behind these programs, how active they are, the people putting it on, running the show, how active the mentors are, and then talk to some of the companies about what the value is they gain from it and what they wanted going in, because there's very different value that you would get from going through Techstars Accelerator to Capital Factory to Unlimited USA, et cetera, et cetera. So kind of step by step of what you want to do. We mentioned doing your homework online, a lot of great blogs. One of our general partners, Gordon Doherty, has a blog called Shockwave Innovations, right up on here, but hopefully you guys remember that one. He's got a lot of great content that he runs through for entrepreneurs on that site. Kind of first thing you want to do if you're really in the beginning stages, how many entrepreneurs do we have in the crowd here? Okay, good. We're talking the right crowd then. And then how many of you are still in the idea phase, let's say, like you're just getting something started, going, okay. And then how many of you are actively pitching investors, ready, hitting the ground running? Okay, great. So this will kind of play nicely into this. But just, first and foremost, for those that are really in the idea phase, is there's a lean startup methodology I suggest you fill out online, where it's really just getting you to think about your business in different ways. But just creating a 1 or 2 page PDF. Don't do a 30-page business plan. Do something that's super digestible. Your team, your product, your progress, what you're doing, and find another entrepreneur that's been through this before, or an angel investor, and just ask for their feedback. Do that a number of times. Once you feel good about that, you can get a real pitch deck together. Still, let's say 5 to 10 slides or so. You're going to get a lot of feedback. You're going to get a lot of no's before yeses. And then kind of the cycle of what do you do next? You're going to get typically, obviously there's a number of different ways companies grow. This is going to be your most general step-by-step of kind of what we would guide you to do, right? But very, very general guidelines. So getting your first few angel investors, probably on a convertible note. That's become really popular in the last couple of years. We'll explain that a little bit later about terms and what VCs and other angels like to invest on, what their appetite is. Potentially applying for an accelerator or other programs to accelerate your business. Kind of the next round would be after a few angel investors or your family, friends, and fools round, what we call them, would be getting your regular kind of a real seed round where you could actually hire some people, get this thing rolling, raising $500,000 to $1.5 million from maybe some real VCs, angel investors. You maybe get to $1 million annual recurring revenue, $1 million a year. You're going to raise a $3 to, let's say, $8 million Series A from a VC. Once you're at, let's say, $5 million annual recurring revenue. Again, these are super loose numbers, but just trying to give you kind of the flow of what that looks like. Yeah, you have a quick question?
Yeah, so the expectations for where you should be for a seed round kind of differ geographically. Like, you need something different in Boston or you need something different in San Francisco. For Austin, what are the investors looking for that seed stage 500K, 1.5?
So really awesome question. When we get our panelists up there, I'm going to have you ask them, and I'll chip in then. But we've got a whole bunch of content on that. So we'll definitely come back to that. So office hours, another great place to meet investors. So we use a vehicle of office hours. Many of you that may have gone to college once upon a time or just around the corner or dropped out, maybe didn't go. This is kind of more interesting office hours than you would have with your professor at school. What we do is we have a number of mentors, angel investors, VCs that put a 2-hour time block on the calendar here. They do it at Galvanize, a number of other kind of tech hubs, where a couple hours a month they reserve for meeting companies. They say, okay, great, 2 hours, you guys can take care of it. JD, I'm interested in education tech companies that are marketplaces at this stage and these kinds of founders. So we go, get together anybody that's interesting for you in that criteria, and we line up 30-minute meetings for you, make it really, really easy. So it's a good place for angel investors to come in, makes their schedule really easy. They can just have a standing kind of couple-hour time slot. We coach you on how to pitch them, how to ask for different things, setting that agenda, and so on. So
this is part of the membership, right?
This is part of Capital Factory membership. I'm just speaking really overall. You'll see a number of different, like Central Texas Angel Network does their own office hours. I mentioned Galvanize as well, but a number of other places in the community too. Techstars, all the other accelerators. This is kind of a coin phrase that you'll hear. So just kind of looking at what do you expect from office hours. Think of it as speed dating. So really the goal is you're meeting as many sharp, interesting potential mentors to your company as you can in a short period of time. Those that are interested, there's a lot of them that just right off the bat won't click. Like you're not a fit, they're not interested in you, they're not interested in your company. Awesome. You should still take the meetings with people that might necessarily not be in your space, because the network of people and the network effect is, hey, maybe their sister does something in this world and might link you up, whatever it is. But always want to research their backgrounds, look at what they've invested in. A really good follow-up question to a number of angel investors and VCs. A number of them will say, hey, I'm not investing right now, this is really interesting. Your follow-up question should always be, what would you want to see or what would you need to see for you to invest in my company? So then you can define goals and help them strategize with you on how you're going to define them. Very few companies do these kinds of things where they tell an investor, hey, I'm going to go do this, and they come back actually doing it. There's a very small percentage that do, and you stand out amongst the rest if you get something done like that. So of course, follow-up meetings. Really, if you aren't making investor updates for yourself and your own company weekly or at least monthly, you should immediately start doing that now. Really great way to track your progress with whether it be users, with your team, with your product roadmap, with your revenues, everything. So you can go to mentors and folks, and you can say, "Hey, are you interested in what I'm doing? Would you mind if I add you to keep you up to date with our monthly investor our monthly investor report?" And most of them, if they are interested, they're going to say yes, and they might just click really quickly. But every time that comes to their inbox, your company comes to the top of mind, right? One of those line items on that investor report should always be what we need help with, or our asks. So you'll get that. You'll form that more formally down the line. So talked a little bit about difference between bootstrap, angel investing, and venture capital. This is a really interesting graph to take note of, which is what kinds of companies are right for what types of funding, right? Like, it kind of, if you think in a common sense way, it makes sense to not give up any of your company. Like, if you're going to grow a really successful company, you should own all of it. There are different companies that fit bootstrap, angel investing, venture capital. So take a look at this. If your company is not very scalable, it's very hard to get scale and growth, and it doesn't take a lot of capital, it doesn't take a lot of money to do it. Let's say it's like a kind of a personal consulting business of sorts. That's a bootstrap business. You don't need to raise any money, outside money for that. If you're taking a lot of money and it's not scalable, you probably shouldn't work on that business. It shouldn't be in the chart. You should reevaluate what the hell you're doing with your life. So then we've got kind of the top quadrant, venture capital. If you've got a highly scalable business that takes a lot of capital, so a lot of these are intense, let's say pharmaceutical companies, where they have a lot of different trials they've got to go through, a lot of hardware companies that are very, very capital intensive, makes sense to raise venture capital. And then you've got this quadrant that's split in the top left, which is where the majority of these companies, all your companies are probably going to fall into place, which is, are there strong or weak barriers to entry? So if you've got a highly scalable business, it doesn't take a lot of money to break into the space. So you've got a software solution that, it only took a couple people to build this product. But you're locked in with barriers and laws, and you've got strong barriers to entry, probably closer to a bootstrap business because nobody can compete, nobody can take that over from you, right? If there are weak barriers to entry and another competitor can move into the space, your advantage at that point is growth and getting your brand recognition and growing as fast as you can. And so that points to the venture capital quadrant. Again, we can run back to this, but this is just a really nice diagram to understand different types of businesses, different types of funding. Okay, Austin venture capital, quite a hot topic the past couple years or so. So here is, we did the best we could of kind of making a generalized list of all the different venture capital firms in Austin, their investment stages, a key partner that they have that you can reach out to that's managing a lot of the investments, and what their focuses are. You'll hear actually Krishna Srinivasan, that's a general partner at Live Oak Venture Partners, was previously with Austin Ventures a while back. Austin Ventures was the very large billion-dollar firm that then split out, and a number of these other small firms have come out of Austin Ventures. So since the Austin Ventures is mostly no more, at least in the venture capital world, in the early stage venture capital world, there's a lot of room for some other players to come in. So ATX Seed Ventures, Chris Shank, focusing on business to consumer companies, and then consumer packaged goods. That's things like making granola bars and tequila and so forth. Build Group is much later stage investments. Napier, all tech companies, but Series B here meaning probably a $5 million check and beyond that, $5 to $10 million stage. Capital Factory here, we've got an accelerator program and a small venture fund that we write matching funds to a number of our companies. Additionally, we invest in other outside companies where we'll cut a small check in the seed stage. Gabu, probably mostly Series A, some seed. Clayton Christopher was the founder of Sweet Leaf, and then Deep Eddy. So started a venture firm here. Corsa Ventures, seed companies, Live Oak Venture Partners, you'll hear a lot more from here. Mercury is actually in Houston, but makes some investments in Austin. Next Coast Ventures, Tom Ball was one of those folks that split out from Austin Ventures. Notley Ventures, you're going to hear from today. Matt McDonald is a partner there, and they're a social impact venture firm, but seed and some Series A. You've got AVX, another breakout from Austin Ventures. S3, a really active venture capital firm here in town. Charlie, probably your main guy there. Sante Ventures really focuses on biotech and then some other pharmaceuticals. Silverton, another really active early stage firm here in town. Kit McClanahan, main point there. Techstars Ventures, we've got Jason Seats on the ground. Techstars Ventures is now solely focused on companies that have gone through the Techstars program. So if you've been through a Techstars, then that's an interesting fund for you. And then True Wealth is really focused on primarily female entrepreneurs. So thought it was really important to browse through that just so you guys kind of have the light background. But there's a new venture capital funds opening every one at least a year, I would say, that we're seeing, maybe multiple. And then additionally, we have a number of venture firms making quarterly visits now to Austin. So it's really being put on the map. We get a lot of throwback of, hey, there's not enough funding and et cetera in Austin at this level. Most of our really great companies are getting funded at least at the seed and Series A level. When it comes to the Series B, then definitely moving outside. That's definitely where we have a strong presence. Here's a quick overview of kind of some of the Austin accelerators. So also very tough to put all of these things, all these accelerators that offer different benefits on one slide, but doing the best we can, it gives you the program, amount of funding that you should be provided with, the amount of equity that you should expect to give up from your company, and then what their focuses are. So Athena Health, more disruption please around health, Capital Factory, Techstars, and YC. Y Combinator is the only one not in Austin, but we're starting to see a lot of Austin companies get accepted and move into Y Combinator. They have been kind of the first brand name there. Unlimited USA makes sense. Social good companies, they don't take any equity, which is very sweet of them. And then SKU focuses on consumer packaged goods. I already mentioned Central Texas Angel Network. They've got an application cycle 5 times a year. The two key people that you'd want to talk to, Rick Timmons is a chairman and does Capital Factory office hours quite frequently. Claire England, the executive director there. So, really quickly, a couple basic things before we bring up our panelists. The funding landscape in Austin, when you're looking at early stage investing, this is typically for technology companies that have under $1 million ARR, annual recurring revenue. The majority of their first funding rounds are all going to be in convertible notes. A handful of them are going to be straight equity investments, meaning like what you see on Shark Tank. We're going to give you this much of our company for $300,000. A percent of them are going to be safes, which is similar to a convertible note that Y Combinator is invented, and all of them should have some type of valuation. So convertible notes, and we'll hear more from more opinions in a little bit here, but the reason a lot of entrepreneurs and angel investors invest on convertible notes is it makes it really easy. It's a cheaper way to not actually go and price around, where they are technically loaning money to a company, let's say typically a $3 or $4 million cap value. So you have investors are going to invest with a cap, with a protection clause, where they say, okay, I'm going to give you $50,000, JD. I don't know what that $50,000 is worth yet in your company, but I want to just delay that. So when you really raise a real round of funding, I just want to get in at a little bit better deal than Krishna or Matt comes in at the VC level. So we're going to do a 20% discount and a $3 million cap, which is very standard, where if I raise then on a $3 million valuation from Krishna later on, then this investor that invested JD gets to come in at 4 out of 5 or 80% of the cost that Krishna got. Or if for some reason my company explodes and I raise on a $20 million valuation, well, it's not really fair for the investor to just get the regular 20% discount. They're in really early supporting you. So there's a cap saying, hey, you get in valuing the company at $3 million. So everybody else is valuing it at $20 million coming in this round, but that's kind of the gist of it. Again, we'll get more in detail about that. So you asked a company about valuation. The number one slide on here, second from the bottom, if you have to justify it, it's too high. Valuation should not be something that you're fighting over when you're negotiating terms with the VC or an angel investor. So the average here is going to be a $3 million cap. In Silicon Valley, it's going to be double, and in New York and Boston, also higher. On a note, you can think of the cap for kind of in the beginning stages as the valuation, as what the company is worth, because that is the protection clause. And you might have a higher cap because you need a lot more money. So in order for this to make sense, it doesn't really matter. It doesn't really make sense for you to raise money at the highest possible valuation. It makes sense for you to raise money at the right valuation. And I say this because as you raise more and more money and you scale faster and faster, you have to continue beating metrics and growing the company. And investors have to keep investing at a higher valuation. You need your company to grow with you. And so if you have people invest on some crazy valuation and then you don't get any investors that want to invest on that or higher, it can be very, very difficult, very tricky. So that's the bigger is not always better point. So time, it's going to take at least 2 or 3 times as long as what you're thinking right now. So 6 to 12 months, kind of in the angel investment range. If you meet, this is from meeting somebody to a check written. Takes a while. You've got to date them for a while. You have to form a relationship. Some investors like to move quicker. Sometimes it can drag out even longer than that. That's the main point there. So kind of with that, no, usually coming before yes. Get used to hearing a lot of no's, but persistence is really key. And I think the VCs will tell you today, like a number of the companies that are so driven that they want to continue improving their metrics and sending updates and actually showing progress, you may get a yes. So say you're going to do something, then do it to the point that I made before. Mark Twister, famous VC, has this quote, which is, he invests in lines, not dots, meaning as you are making those investment updates and you are connecting your dots with lines and growth, that's what he likes to see. Not so much your idea and your grant. That has to be there too, but investing in lines, not dots. So hopefully that was a quick kind of great overview for you to get comfortable with the Austin landscape. With that, I would love to invite Krishna Srinivasan, general partner at Live Oak Venture Partners, and Matt McDonald, partner at Notley Ventures, to come on up. And I'll get started with just a couple of questions, and we'll turn it right over to you guys who can ask questions. So, well, let's do that. Stand up here for now. So, why don't we do? I got my mic up here. I'm gonna sit down there with you in a minute.
Got it.
But yeah, why don't you give us just a quick intro? So, kind of name, firm, what the firm's thesis is, and how you got into venture capital. Whoever likes to take the first shot.
Krishna Srinivasan, thanks for all the plugs in your speech. Very well done. Great landscape of the market here. I've been this is my 17th year in the venture capital business. I got into it when I was 10 years old. So 17 years doing early stage venture capital investing here in Austin. First 10 years of that was at Austin Ventures, doing pretty much the same thing. And then 2 of my partners and I, all of us at Austin Ventures, left to raise our own fund. Raised Live Oak Venture Partners about 3 years ago. It's a $110 million fund, completely focused on Texas-based companies. We describe our strategy in 4 buckets. A, we are pan-Texas, of course, with the bulk of activity happening in Austin. Number 2, we look to be first institutional investors. In other words, you might have, it could be 2 guys and a dog, as I describe it, or it could be someone who is bootstrapped pretty successfully, as JD described. and then we come in to invest in that business when it's got some revenue traction. So we look to be first institutional investors in companies. We are investing $2 to $4 million typically in the first round of financing, and then over the life of a company, we invest $7 to $9 million. Pretty active investors. So traditional, what you hear about venture guys, we always take board seats and always pretty active in with you on company building and help build a meaningful, hopefully meaningful sized company here. And the last part, I would tell you, the fourth aspect is we're very, very entrepreneur focused in terms of what we do, more than being segment focused. So people ask us what segments do we focus on. We say it's hard to be both, when you're geographically focused, it's hard to be geographically focused and be segment focused. So I think we look to kind of, I think the firm's story is to be backing the best of what Texas has to offer. So we end up being fairly segment agnostic, but back local entrepreneurs pursuing great ideas, big ideas is what we look to do. So that in a nutshell is what we are, and happy to add more color as we, during the Ask Me Anything part of it.
Great. Matt McDonald. So Notley Ventures is, sorry, is this not on?
I don't think so. There's nothing. It's not on. Can you all hear me okay?
Testing. Okay.
Great. So Matt McDonald, Notley Ventures is a little bit differently organized. So we really, our genesis was first as a family office and angel portfolio for Dan Graham, who was the founder of Build a Sign that folks might know here in town. So I got into this business by having a company of my own, mobile content distribution platform, raised some money from Dan as well as from a number of other folks that you saw on that board up there. And as I was leaving that business, was always sort of looking for an opportunity to work with the Grahams more meaningfully, that rather than just having them as investors. So when they decided to start Notley Ventures about 2 years ago now, came and joined them full time and sort of took an existing portfolio and have really sort of put some structure around it. So we do a couple things. Before I dive into what Notley Ventures specifically does, one important thing to note is that if you are a social impact entrepreneur, we also have a philanthropic portfolio. So while my mandate is purely for profit, we do have a philanthropic portfolio where we will make investments in nonprofit organizations and social ventures that look and behave a lot like businesses. So what we don't do is grant making, but if one of those organizations wanted to launch an earned revenue model, we would consider a seed capital commitment for those folks. But Notley Ventures is really focused on seed stage here in Austin in particular, although we will be opportunistic about other cities, so primarily San Francisco, Seattle, and Chicago. We're starting to spend a little bit more time in Denver and Boulder as well. And so our focus is really seed stage tech, consumer packaged goods that are a little bit further along. So think more, we'll do seed stage investments there, but CPG really when it starts to look like an A-round deal, we'll start to get a little bit more interested there. And then we also do two other things that I think are a little bit less traditional. We do revenue-based financing, which is essentially a debt instrument. So that's also primarily focused on CPG companies. So it's really just a way to offer founders non-dilutive funding without providing a personal guarantee. So it's has some benefits of debt, but also not necessarily some of the problems associated with it. And then we also are fairly active in the real estate markets, but primarily to serve our portfolio companies and provide office space for those folks as well.
Okay, great. So next question is, how many investments has your firm made? And if you could give maybe one of the highlight investments and what that company does.
Sure. So we're at about 50 deals right now that are non-real estate deals. I think one of the companies that a lot of people might know about, I'm going to cheat and mention two. One is Scale Factor, which is actually noticed that it's very, very hard for startups to get good accounting services. And so they sort of power the back office for a lot of the smaller companies here in town as they're growing rapidly. There's some really unique challenges there. Then another one that folks may be familiar with is a company called Broomly. They are Uber for cleaning your home. They watched HomeJoy raise $65 million and spend $85 million, and said, you know what? I think if we get the unit economics right first, then we'll go and we'll scale rapidly after that. So those are two highlights for us.
To date, I think we have 17 companies in the portfolio. Our first investment was third quarter of 2013, so you can get a sense of the pace here. Out of the 17, we have 5 of those are still seed stage companies. So at seed stage, we invest $250,000 to $500,000 in a company, and the other 12 are Series A stage and beyond companies. Companies that where we have invested something north of $2 million in those 12 companies. Out of the 12, one of them has exited. We sold a company called Stack Engine last year to Oracle, an early exit for the fund. So net we have 11 active Series A stage companies and beyond, and 5 active seed stage companies, which hopefully one day become a Series A stage company and beyond for us. An interesting company, would be kind of in the middle of the fairway for us, as JD said, is a company called Disco. They build software for e-discovery. If you're in the whole litigation process, you get millions of documents get discovered, and then the company is working with lawyers to collaborate on the tagging of these documents, what to submit for litigation purposes, and then you review, you process them, you produce them, and you use this software through the life cycle of e-discovery. And this was a company which had pretty modest revenues in 2013. In December of 2013, we invested in the company. We were the only investors in that. We invested $2 million, publicly disclosed, into the company as the sole investors here. Fast forward to today, the company's raised $35 million in total. Series B was led by a firm called Bessemer Venture Partners from New York, who came and led a $10 million financing there. And then recently we announced an $18 million financing or $19 million financing led by Stevens Group of Little Rock. Clearly the company has obviously grown, almost approaching double-digit millions of dollars in revenues now within a 2.5-year period. So wish we can keep replicating that kind of a success repeatedly. Unfortunately, it doesn't always work like that. But that's an example of a company where we spotted an entrepreneur, spotted a macro market need, highly litigious society, wonderful. So let's build software for that. It's the first of its kind cloud-based software for what is typically on-premise software. So we look for trends like that, large markets, big macro secular trend of going from on-premise software to cloud-based software. The founder was a lawyer, had a lot of domain experience. So we like that combination of, again, back the entrepreneur in a big market with a macro secular trend in terms of technology that makes sense. And fortunately, so far at least, that bet has proved to be right in terms of the company's growth that it's experienced the last 2.5 years.
That's great. So you mentioned you spotted a great entrepreneur with industry expertise. So one, how did you find him? How do you find your new investments? And then two, how do entrepreneurs find you? I think the spin-off of that, how would you like entrepreneurs to find you?
Well, let me tell you, the reason I'm here, right? We are as eager as you guys to meet you. Some of you might not believe that, but so constantly looking to meet you all. Amazingly enough, Disco came to us over email. It came to us through plans@liveoakvp.com. So not a complete cold. Nobody referred Disco to us. No fancy entrepreneur did that. We didn't know the entrepreneur from before, and it literally came over the transom to us. So out of the 17 investments we've done 2 of those have come from plans at Live Oak VP, and both of them now are Series A stage and beyond companies. So, but obviously it helps always if you're vetted, if JD emails me about, hey, it's an interesting company that's here, I'm excited about, we obviously will, pay more, immediate attention to it. But we're also of the philosophy that anything that comes up through plans at Live Oak VP will at least ultimately get noticed by a partner, and you'll get a meeting with a partner at Live Oak Venture Partners if it's kind of in the strategy fit of being first institutional company for tech-enabled services company here in Texas. You can always email me directly. My email address is Krishna, KRISHNA @liveopp.com, and we try to obviously reply and be responsive to every email that comes to us. Is that?
Yeah, that's fair.
Sorry. Let's leave the market.
We'll leave you with one. Okay. Yeah, so I think it's the same idea, right? I mean, we're here for a reason. You never know where you're going to find the next great company or the next great entrepreneur, and so we meet people all sorts of different ways. I think one thing that tends to work pretty well is to get on a calendar for a coffee meeting, right? So I think the email is sort of the start, but if you think about an investment as kind of a marriage, right? We want to start spending time with one another pretty early on and figure out whether or not there's a real sort of mutual affinity there. So I would agree with Krishna. My email is matt@notleeventures.com. So I think it really is a numbers game for us too, right? I mean, we need to talk to a lot of people and meet a lot of folks, and I think the intention is not only do we sort of have those conversations, but the hope is even if there's not an investment fit, you sort of leave that conversation better than you started, right? And so we're always trying to figure out how you add a little bit of value even if there's not an investment relationship to be had. I think the other thing that's interesting too, a little bit different about our model, is we do syndicates. So as opposed to raising a fund and having a lot of LPs, the other two ways that we find our deals is we become LPs in funds like a Live Oak or a sort of seed stage, or excuse me, Series A fund. And then our syndicate is also a referral source for a lot of deals. The other thing that we do a lot is as companies grow, right, there's not, the team that takes a company from 0 to 10 million is not necessarily the team that takes a company from 10 to 20 or 10 to 25 or wherever they go. And so when folks like Krishna get involved, that's usually an opportunity for us to recycle some of those entrepreneurs and say, all right, take a little bit of time off and then let's talk about your sort of next opportunity. So we really have a strong preference for serial entrepreneurs that we have some sort of relationship with.
Yeah, I think, so also, I'm just JD at capitalfactory.com. We've got, so at Capital Factory, we, a little bit earlier, and then we also look at companies that are seed and Series A. We've got equity stake in 162 portfolio companies. Number that come in, through about 100 of them have come in through the accelerator program, and another 50 plus then are outside what we call opportunity investments. Always the number one way, first, like, we're finding new investments. We're using a number of different softwares to source deals, software like Mattermark and PitchBook that scrape the internet. So if you have an updated AngelList profile and you're on Crunchbase and things, we see that and we get those updates. But also, all the news sources, if you're ready to be noticed and get press and get your company out there, Built in Austin, Silicon Hills News, Austin Inno, all great local Austin tech sources that you want to connect with and be kind of in the headlines with. The last question to that I want to ask, I personally like to meet companies as early as possible to then establish goals and metrics that we want to, hey, in 30 days, let's see if you can do X, Y, and Z, or 60, 90 days. Of which like I said, a very small percentage of entrepreneurs actually do that. Those that do, there's often a chance that we actually invest in them. But when is a good time that companies should engage both of you? At what stage in their company, or explain what they should maybe look like?
Yeah, so I mean, I think for us, it's definitely early. Like JD said, so one of our best referral sources is law firms and CPAs, right? So as you find, as a company gets to the stage where they need those kinds of service providers, that's kind of a good hallmark, right? Like you're a little bit past, setting up your LLC on LegalZoom, but you're not so far along that you're sort of been operating for a few years. So I think that's that's sort of a good benchmark. But there's really no time that's too early. I think also one of the things that sort of helps is to share a little bit of information, right? So don't send a Dropbox link to a due diligence folder, but if you have something that can be consumed, an executive summary, or point us to your product even better, just something to kind of give us a sense of what you're really up to. I think that that's really helpful, and it's never too early to start. And I think something that JD, I think he probably showed this slide. We're looking for lines, not dots, right? I think it's really in everybody's best interest to develop that relationship as soon as possible, and it really is a relationship, right? It's not just I need to ask for funding 5 times and then it will open up this magic door. It's let's actually get to know each other, and one of the good ways to do that, I think, is there's this adage: ask for advice, get money; ask for money, get advice. And so I think the best way to work with people is to actually sit down and work on a problem together, and it gives us insight into how you think. And there's no time in a startup's life where you don't have problems. So you early rather than later, I think is a good bet.
On one side, we definitely advocate no idea is too early from a Liveworks perspective. As you can see, we've done more than half the portfolio. It started off as pre-revenue companies that we invested in. But having said that, I think the pre-revenue companies end up being ones where there is some sort of a meaningfully characterized technology differentiation. Somebody's solved a hard problem of doing blank, and perhaps they have prior entrepreneurial expertise. Earlier this year, we backed the guys at Ojo Labs. Ojo guys were the founders of Yodel, which they built it from 0 to $200 million of revenues, and also working on a brilliant idea in the chatbot arena with a wickedly cool technical team. So it kind of ended up being a strong alignment of really smart guys, been there, done that, with some real deep technical differentiation, and with a large market. That's one where we backed them before they had revenues. So what I would tell you is, I think in one way I would tell you is where JD's chart he put up. If you don't belong to have built a $100 million business before, maybe it's not that high a bar, haven't built a meaningful business before, a first-time entrepreneur, it would surely be with an insight, not quite one with, where there's a clear product differentiated approach to doing something. I think the recommended thing for you to go talk to venture investors would be with some amount of revenue traction, to demonstrate that your insight that you have is spot on, your insight about the market need, market opportunity, that you have intersected that well with your product approach that you're going after, would be probably best use of your time. If you have angel money, friends and family money, to get over that, cross the chasm there, to demonstrate and prove your insight can lead to some revenue traction or to whatever KPIs of relevance to you. Maybe it's user engagement of some kind, user stickiness of some kind with the way you're going about it. It obviously stands you in much better stead with respect to getting some venture money for it. I think clearly we're also of the opinion, right, where it is a long-term relationship, and clearly if you were to come in with a really early idea, it's good to engage, it's good to get some feedback, get an early discussion going. When you come back in 6 months' time and you've started to crush your numbers, it definitely adds more credibility that you've outperforming what you set out to do, etc. But what I'm giving you are general guidelines and framework to think about it, and it's kind of take advantage of places like Apple Factory and other places like that to get you on further down the path of getting some early revenue traction going, which shows kind of dog to the dog food, as people say, before you would truly go raise institutional money, would be probably the best use of your time.
Great. And just so I'm going to ask a couple more questions, and then we're going to open it up for the last 30 minutes to you all. Krishna and Matt, you guys both went into detail about kind of some of the matters that you look for in companies with in respect of how you decide, right? So you talked about team and product differentiation and your market opportunity, all these different kind of avenues. Of course, most entrepreneurs don't have all of those in alignment. So I think, please answer the question of maybe what are some key factors that makes the light bulb go off? Maybe your top 2 or top 3 factors where, okay, this is a company we're really interested in, or hey, we want to do a little more research, and they're definitely, check ready.
Easier said than done, right? From our perspective, which is, let's take the first company I told you about, Disco. Those guys had gone from a standing start 8-9 months ago to, double digit, thousands of dollars per month MRR in a matter of 6 to 7 months. Approaching mid double digits MRR. There was something about it which was clearly demonstrating that with limited resources, they were getting real traction like that. And obviously, numbers like that sort of speak for themselves, which prompts folks like us with no referenceability, no introductions, sit up and take notice that you can go do something. So number 1 is you look for early traction. Number 2 is you really spend time thinking about, can you truly build a long-term sustainable business? Is this is this really scalable? I think as JD said, do you really have to, are people putting fuel into the fire to get this to grow, or is there a structurally sound reason as to why a certain business can grow more efficiently? Can it be capital efficient and grow well is what we look for. Is there a natural competitive motor on the business? In other words, as this business gets to be more and more successful, does it make it harder for competition to come up? Perhaps it's using up a lot of, it's spewing a lot of good data, which makes it a virtuous cycle. The more data it spews out, the more valuable the service becomes. And so for someone to start afresh, they don't have the benefit of the historical data accumulation for them to get started. What are some competitive modes about the business to make it sustainable? I think we spent a lot of time thinking about that, as in how do we not brute force a company execution. I mean, if you can make an argument of how can the company be relatively capital efficient and yet build a sizable business, that's what would be the a great combination that venture guys like us look for. Beyond that, I think there's a long list of each situation ends up being fairly unique, and always open to do this one-on-one because your situation is fairly unique, and it'll always be useful to have a contextual discussion on what the goalpost might be for you all to demonstrate this might be venture backable.
Yeah, I think I would answer that question with a little bit of an analogy, right? So if you think about trying to surf, right? Sometimes you time the wave right, sometimes you don't, but when you do, you know it, right? And so I think there's an element to that here of like JD said, it never all lines up perfectly, but I think timing is really important, especially for certain markets, right? So if you think about the businesses that did really well in mobile, you're seeing relatively few mobile businesses, but lots of businesses have mobile products now, right? So there was clearly a timeline there that made sense, and so you need to be attuned to that. I think that the team is always the most important thing. So if there's one sort of universal truth, it's that something's going to go wrong. Most likely, many things are going to go wrong. And so at the end of the day, you're really left with an entrepreneur. And so what we're looking for there is really alignment, right? So are they properly incentivized? Do they deeply care about the problem? There are a lot of really good ideas, but the entrepreneur might not be the right person to solve that problem. So in the example that Krishna gave with having an attorney deal with document discovery and management, well, that makes a lot of sense. So similarly, if you were to finance a financial services company, right, or a fintech program, we would want to know that that person had really deep experience in that area, and that they were doing it because they were genuinely intrinsically motivated. So I think that that's really important. And then I think that the last part of it is just sort of it's the finances, right? I mean, at the end of the day, I think people talk a lot about product. People talk a lot about product market fit and market opportunity, but I think what Krishna said also resonates with me, right? It's putting up those numbers over and over again, and it doesn't have to be. You don't need to hit $1 million in revenue day one, or even in that first year. But we're really looking for trend lines, and in particular, those trend lines that can grow exponentially.
Great, so super insightful answers, thank you all. I want to make sure we have some time to take some questions from the audience, so I will turn it over to you all. So first up.
Hi, my name is Donna Kawasaki, and I have a solution for hearing loss. I have fixed hearing loss in more than 1,000 people. My question is, so the reason why I fixed hearing loss, when I gave birth to my child, she was over 10 pounds and she got stuck in delivery, and 4 nurses with on and I pushed on my back, and they fractured bones in the back. Bones in the back. So over the course of the next 16 years, I had 8 surgeries I never should have had. They finally did the correct surgery in Singapore, and I have collaborated with more than 200 companies. The market opportunity, hearing loss actually affects 1 in 4 people, 20% or more, and that statistic has actually been shown by Sheryl Sandberg and her mom. I've collaborated with people like Vince Cerf. I've moved to Austin because it has one of the best schools for the deaf in the world. It has a very large population of professional musicians, elite athletes. I've trained professional athletes, so to fix my own hearing, the first was to fix the structure, and the second was to apply the other concepts. My question to you, unfortunately, I cannot, for example, drive up to Capital Factory every day. That would send me on a downward spiral. In terms of capital efficiency, for example, employing moms that could work 1 or 2 hours a day would be ideal because they would be able to capture these case studies. So I guess my question is to try to understand within this environment how I can set up the company and scale the company in a little bit modified way than, for example, what you've described.
Are you referring to talent? How do you hire top talent without maybe being physically in this ecosystem downtown?
No, it's more about being connected with something like Capital Factory,
Okay.
but being able to have for example, the headquarters on 71 close to my house, or employ the employees that are from their homes, not having
Got
them need to come into Capital Factory, because then I know that I can employ moms for,
I'm gonna let Matt and Christian take a shot at it.
Yeah, no qualms there, right? I mean, I think it's all about execution. So that's, I think that would be my perspective, right? I mean, we have lots of people that, especially in co-working spaces, one of the most common things is people will work from home on a day, and then they do all their conference calls that day because that's where it's quiet, right? So I think it's more about execution than butts and seats or 9-to-5 schedules or anything like that. And there are lots of really successful venture-backed companies all over town here, right? I mean, it's not just right here in downtown, although Capital Factory is certainly a hub, as is Techstars, but Tech Ranch is out in the western part of town. So there's lots of places, but I don't think it's, the thing about accelerators and incubators is that they all have a unique characteristic and they're right for certain companies and personalities and workforces, but it's certainly not a necessary condition.
Yeah, there's a lot of, there's nothing wrong in having a part-time workforce like that. Bazaar Wise had a big part-time workforce of stay-at-home moms who are curating the reviews for the sites. So there's nothing wrong with that. It's all about, as Matt says, how do you harness that energy and the force efficiently to, build a successful business. That's all matters the most.
Yeah, right in the front.
Thank you. So my name is Javier Malave. I'm visiting from Houston, Texas, via Puerto Rico. So that's sort of my background. But I know it's not a good taste sometimes to ask 2 questions, but I would love to and they're very succinct.
Start with one.
I'll start with the first one. You mentioned the serial entrepreneurs and understanding that entrepreneurship is a long-term commitment. What is your typical timeline and what do you look for in an exit strategy? Or I should say, what is your typical exit timeline? What do you look for in an exit?
Hard to brute force exit timelines. Historically, we just invest in a company which exited in 14 months, and the companies which have gone on to exit in 10 years and be public companies and so on. I think, companies, it's all, I think the way to think about it is 2 things. A, you almost, we at least believe in, build a sustainable company and, good things naturally happen to them. If you're on the path to building sustainable value in something, and you can't prove. And number two, companies are bought and not sold, in the sense that, we could not have sold a company like Stack Engine so early unless Oracle came and made a compelling argument why they ought to buy the company from us. So it's just a matter of having, these things just happen when they happen, right? So I think it's very hard. These are not like traditional, it's not like selling an apartment complex, when you say I'm gonna build it and I'm gonna sell it in 3 years and I'm gonna apply a X% cap rate on it and it's gonna happen, right? It's not like that. These things just, it's very hard to brute force when a sale happens in these companies.
Let's go in the green shirt. There.
You talk about the process of, after you've met an entrepreneur, the process of moving from meeting to actually closing the deal, and how long that typically takes.
So the question is, what's the process from your first meeting with an entrepreneur to actually writing a check?
So I think, and just to kind of close the loop here on this, the prior question too, I think the other way to think that I think about it is we're also not thinking about exit timelines. We're thinking about how long until we pass them to the next partner that can shepherd that company, right? So as seed stage people, once an A round or B round partner comes in, we kind of, not that our job is over, but we kind of, there's a sort of exit feeling there where they have a new set of introductions and relationships. In terms of, so I think in terms of the timeline though, it really depends, right? I mean, it could be years. If the first time we meet you is, hey, I have an idea, would you give me a little bit of feedback? And then it takes you 2 years to really build a company. So I think we think about it as we invest in companies, not ideas, right? And so that really does influence the timeline, but assuming that everything looks good, sort of 30 to 90 days, depending on the level of diligence. Sometimes we'll move a lot faster there too. And I think that's another distinction that you want to draw. If you're raising money from angels, right, you might want that to be a sort of shorter time frame. But if you're looking for an institutional lead investor, you should expect a longer diligence process, because they're really sort of vouching for you and going out into the world and saying, we've taken a look at these guys, all these things make sense. So it's somewhat of a non-answer to say it depends, but I think the characteristics that you really want to think about are you truly quote unquote investable when you have that conversation, and then the timeline follows from that depending on what you want from that funding partner.
Sure. How about in the back of the glasses?
Yes, my name's Matt Murdoch. I own a commercial equipment brokerage company for the last 3 years. We've been really successful the last couple of years, and we very much fit that bootstrapping model, only because unlike a lot of early entrepreneurs, we're very poor and didn't really have many options to go except to bootstrap it ourselves. So we're a little bit later in the stage as far as where our company has gone and where we've grown. We've kind of grown organically and slower and built it out. And we're not necessarily in a situation right now where we need a large capital investment with the company, but we are in the town and the organization hitting a point where we want to grow to the next level outside of what we've done so far in our revenues. And we've bootstrapped as far as we can with the skills we've had from the partners and the fact that we started with 3 years ago. So my question is, I'm just curious, for both your companies, and for other people in the room who might be in this stage, what can you offer other than maybe just capital or funding investment to somebody who might be in a later stage that also might need a little bit of guidance on how we continue to grow and build out a model? And other than just funding and money, what advantage might be there for other entrepreneurs who might be in a not that big stage, but trying to go through the next third hump?
So what else do venture capitalists bring to the table rather than just funding?
Money.
That's a good question. I'll give you the marketing spiel on it, and but at least let me tell you what I think we offer to the table. I think if you go look at one of the most important things venture guys do. Let me try to describe it. Let's see if you all appreciate it or not. I've been doing this for 17 years. We've seen the movie a few number of times, right? We've definitely invested in companies which have real revenues, single digit, multi-digit. We have taken companies from 0 to a couple $100 million revenues a couple of times. So we have seen a lot of twists and turns of kind of seen the movie before. So I think the first and foremost, what we offer our entrepreneurs is kind of
is a thought partner. You know, being a CEO, being an entrepreneur is a very lonely business. So we offer people a thought partner who shares hopefully the common zeal to build a dominant company in an industry, and thinking about everything from how should you slightly tweak strategy, how should you tweak the milestones you ought to be going for, how should you think about financing to get to the next stage of the company, just everything about building a company here, right? So we are in the foxhole together to work with an entrepreneur to ultimately build a big company, and the benefit an entrepreneur gets is that we've kind of been there, hopefully seen that pattern before, and we are kind of being helpful as a pattern matcher along the way. That at the highest level is the value add, but beyond that, very tactically and very active in team building. There are companies in the portfolio where we have introduced to the founder and the CEO practically every member of the management team, and we are thinking a lot about what is the right skill set, and the fact that we are an investor in the company and we are on the board means the company has been vetted through a certain institutional evaluation process, makes it more conducive for strong talent to then come on board of the company, join the company. So we're very active in team building. We're very active in making introductions for business development, partnerships, etc. And lastly, very active in follow-on investing type discussions, right? Companies often take multiple rounds of financing. You want to invest in the next stage of growth, and we introduce the company to prospective other investors to come on board to invest in that. So I think it's just a part of a continuous process. It's not like one thing that we do here, beyond the money here. It's just, whatever it takes to build a really successful company is how we approach the situation.
I think I just want to add too. I think you're starting to see another model pop up, and we're playing around with this ourselves. It's borrowed from private equity, but sort of having an operational team. And I think you see this a lot in incubators and accelerators. So when we make an investment, we often will take a couple of staff members and sort of be an auxiliary team member to get you through certain humps. And I think a lot of investors do that too. So for example, if you have an early stage company and they just can't figure out why they just keep missing profitability, right? Well, we might dive in and do some of that analysis and sort of help. So there's definitely, I think, a trend in the venture world towards sort of rolling up sleeves when it's possible. Now, you can't do that with every company, or at least not for a very long time, but I think you're starting to see a lot more of that as well.
Else? Right here in the orange shirt.
My name is Karthik. I live here in Austin, Texas. So my question is, in your portfolio companies, what is the ratio of serial entrepreneurs to first-time founders? And then I, being a first-time entrepreneur, I want to know what are all some very good traits of a first-time entrepreneur? And maybe you can share some interesting stories about successful first-time entrepreneurs in your venture capital career.
So the question is, in your portfolios, what's the breakdown of serial entrepreneurs compared to first-time entrepreneurs? And what qualities do you look for in first-time entrepreneurs?
I don't know the answer to the breakdown, but it's definitely heavily weighted towards not first-time entrepreneurs as CEOs. So there are a lot of people in those companies that are quote-unquote first-time entrepreneurs, but maybe aren't the founder of the company or sort of on the executive management team. I think the other thing to note is when you think about sort of the social impact of venture capital, one of the things that we experiment with quite regularly is how do you have, if you have a for-profit mandate, how do you sort of have a social impact? So big companies always have an impact. It's up to them to decide what it looks like. But the other thing that we think about a lot is how do you help first generation entrepreneurs in historically undercapitalized demographics? And so I think to the extent that we're willing to take a risk, right, all things being equal, we're going to give somebody a shot that might not otherwise have access to that opportunity. So I think it's that's really how we think about it. But if you're sort of looking at a first-time entrepreneur and a serial entrepreneur, right, from a raw finance standpoint, I think that's important. And then in terms of character, I think it's really kind of humility, right? It's the ability to own your mistakes and be very, very, this term radical candor is thrown around a lot right now, and I think that's really a big part of it is your learning curve is going to be brutally steep. So are you the sort of person that's comfortable with that and can do that for years and not just a short period of time?
We actually have a greater skew of first-time entrepreneurs. I would quite exactly count it out of, let's call it the 17 companies now in the portfolio. I would say more than 2/3 are first-time entrepreneurs. So for those of you in the audience of first-time entrepreneurs, like the guy I told you, the legal guy, he was a first-time entrepreneur, right? I can tell you, if I sat back and thought about it, I would tell you the Ojo or Yodel example is a rarity. The Bret Hart is a rarity, just because there aren't, frankly, that many. Austin is still a young entrepreneurial town from a overall level of repeat guys who've done well and so on. So you look at the amount of energy in this town, right? You see a lot of first-time entrepreneurs. So if you feel like you're a first-time entrepreneur, you should feel encouraged that that's typically the pattern. In fact, first-time entrepreneurs have much more boundless energy in some sense, where they really want to make it happen, and that's actually very healthy. To add to what Matt said, the kind of things about first-time entrepreneurs are a slight twist on what maybe a different word to I would use to say is we look for very authentic people. We call it authenticity. Just be honest about what you know, what you don't know, and honest about what what you don't know about where the business needs to go and what kind of risks that you believe are there. Be authentic to yourself first of all, and be authentic to us as an extension of that. I think that's a really important trait. I think all the first-time entrepreneurs who are doing really well in the portfolio definitely fit that mold first and foremost. The second characteristic is, if you're trying to learn this is the first time to be an entrepreneur, I would encourage you all to anchor off a domain area you know something about. It's tough enough trying to learn to be in a new role of being a first-time CEO, first-time entrepreneur, and you are a long time, you've been selling computers, and suddenly you want to think about being a healthcare guy. It's a challenge to be new on two different dimensions. A role is new, as well as you're trying to be in a brand new industry. We don't have natural instincts about the space and so on. So if you're a first-time entrepreneur, I would encourage you to stick to your knitting in terms of an industry that you know something about. And the third thing I would tell you about first-time entrepreneurs are, they end up being, again, the authenticity leads to them being very, very data-oriented. They want to constantly look to improve, look for ways to tweak, enhance, augment the business, end up being very data-driven, work tirelessly hard to improve what they do, and have boundless energy, aspirations to conquer the world with respect to what they do. I mean, those are the traits we have seen which go well with being a first-time entrepreneur and being successful.
I think just lastly, our breakdown is about 70-30, 70% first-time entrepreneurs, 30% serial or repeat. And the one characteristic I would put out there too is persistence. Actually, the majority of our companies that have raised large Series A or Series B rounds, no breakdown to whether they're serial entrepreneur or first-time founder, but all of them, their ideas now, their companies, are something completely different than what they started out with. And they're persistent with being an entrepreneur and going with the flows and finding the niche in a market. So they found out so much about one specific industry, and then they went to where they migrated to where the largest problem was, and they went and solved that problem. So Crate Joy is a really great example of that. They're a subscription commerce company for Fox of the Month Club. So like Stock of the Month Club, they build the technology behind anybody that wants to start a business like that. So with that, we've got a couple more, time for a couple more questions.
My question's for Matt. I've interfaced with several social funds, and usually they're trying to strike a balance between profitability and social impact. You mentioned that your portfolios are separate, I believe. Which came first?
So the venture portfolio came first. I think this is a question that we get a lot, right? Like, are you willing to make a compromise on returns? And I don't really see a reason to. do that. And so I think, one of the things that I started to talk about a little bit earlier was, think about Facebook, right? Like, it's clearly not a social venture company, right? That's not how it started. But you would be very, very hard pressed to make the argument that they didn't have a positive impact on the world. And so I think what you're seeing a lot of in this social impact space, and we're LPs in a couple of there's very few institutional funds out there. But what they're really trying to do is find those entrepreneurs that I think, like Krishna mentioned, you are authentic, you're trying to solve a particular problem, and maybe it's corporate social responsibility that provides the impact, right? Or maybe it's just you're gonna get so darn big because you sell a product that everybody needs, and that's gonna have a positive impact. So I'm a little bit less dogmatic about what counts as sort of social impact, and I think it's because I'm not willing to compromise on the returns.
Cool. Let's do one more question, and then I want to give a couple minutes up till 6, so then we can have kind of individual questions up here. So back right there. Yeah.
Hi, Ashok Kumar. My question revolves around when you have an idea, conventional wisdom basically tells you that you find a niche and you really nail that market, and then you grow from that, grow from there. Now, obviously, when you're looking at from a VC perspective, you're looking for scale, you're looking for growth, you're looking for a lot of bigger things. So there's obviously a journey to get from A to B, right? To visualize that journey, do you expect the entrepreneur to kind of pitch you at the time of when they're proposing you, or do you look at things like, okay, right now, self-driving cars or kind of thing? You kind of have your own little crystal ball or your own little market research that you do to see that this could be the possibility. How do you make that? How do the VCs sort of look at the journey for me?
So the question is, how do venture capitalists approach entrepreneurs that are pitching companies, that are pitching the vision of their company? What is ideal here? Do you already have your criteria and markets and things that you're already looking for? Or describe a little bit of how you approach that conversation.
I think the way you articulated is spot on, actually, in the sense that I think the best companies go and crush a niche market. We call it, you have a great tip of the spear to knock something down. And the ones that have shown maniacal focus and clarity of thought and making that happen, I think there's a very high correlation to success. And besides, you can do that in a very capital efficient fashion. So we love companies like that. But also with the corollary that, if that's a smallish market, you definitely want to have a candid conversation with the team, with the entrepreneur, as to what's the hypothesis on the bigger market. You want to be investing in one where just because you go conquer the niche, then there is a natural extension which positions you to be successful in a larger market. We don't know if that's a valid hypothesis or not, and so you would go invest in a Series A or investment there, where you continue your progression towards crushing that early market, but then start to show that an early cohort of customers where you can, by extension, go from the niche to something bigger than that. And obviously, it's a combination of the persuasive arguments the entrepreneur provides as to why there is a bigger golden egg to go after there, combined with obviously our own instincts about the macro market is one that we buy it, believe it or not, and substantiated with our own checks and market research. All this goes together into the crystal ball. We're not coming into the meeting with one giant crystal ball there, right? You're informed by the perspectives and the two-way discussion with the entrepreneur, combined with that leading into some sort of market research and discussion with experts as to why some sort of a dominant position in the first entry market naturally translates to, gives you a higher shot at being successful in something bigger and broader. And that's exactly how we would approach the problem.
Awesome. Well, guys, thank you so much. Thanks to our panelists, Matt and Krishna, for coming out. Thanks for all your questions. We're going to hang out for just a couple minutes here. I want to introduce one more person, Seth Snyder. Will you raise your hand in the back? So Seth works on the marketing team at Live Oak Venture Partners. He's also worked alongside me at Capital Factory with our accelerator program, so another great person to talk to about both our organizations. But with that, enjoy the rest of Austin Startup Week, and thanks for coming out.
What sector?